Uruguay has a lot of benefits in terms of farmland class, if you will. When you look at farmland, you look at where is very productive soil. When you look at farmland as an investment, you look at where is productive soil in a safe, stable environment that I'm not going to get my land confiscated, I'm not going to get my legal structure confiscated, or the taxes are suddenly going to jump up because the administration changed and now they went from 25 to 50% tax on foreigners. I've got representation. So there's a lot of factors that go in once you become an investor in farmland. At that point, you've got the sovereign risk, if you will. That's political risk, economic risk, freehold ownership. Do you have direct access to the land ownership-wise and legal standing? And then outside of that, how much is the land itself? Is this a good investment? What price point are you buying in at? So Uruguay has the political and social and economic stability of the US, which makes it a safe investor environment. You've got freehold ownership. Certain countries like Canada, you can't buy the land unless you're Canadian. There's a lot of countries that have restrictions on foreign ownership, so that changes the model. The land is super productive and as good as the best land in the US. They also have an advantage that they haven't been farming for 70 years. They've only been farming for, say, 20. About 60% of the land is still cattle use. And the final point is the land is half the price that it is in the US. So what you're really looking at here is you take out the political, the economic, the currency risk, the purchases are in US dollars, the land's the same. So when you start knocking things out, what you've really come down to is that it's just a safe investment environment as the US. The land is just as good. So what you're left with is what's the price differential, and the price differential is 50%. So the land is half the price in Uruguay that it is in the US. It's 40% of what it is in Europe, in Western Europe. So there's a substantial price arbitrage, if you will. And what that ultimately means is that the demand is the same and the spot prices for crops are the same. So obviously if you pay half as much, you're going to get a much higher return. And there's more room for the land to appreciate.
We also talk about this in terms of your capital advantage. So Arlen's already pointed to the fact that land prices are half what they are for equivalent land in the US. Now the US has a snow line, and south of the snow line, call it Georgia and Florida, you know, there's some good farmland, and it has a double cropping opportunity. Uruguay is also south of the snow line. So you have not only the 50 cents on the dollar valuation of US equivalent farmland, but also they've got double cropping opportunity. So you really have a 4x capital advantage to investing in the United States on average for farmland. So it makes it very attractive financially. And as Arlen said, this really changes your denominator in your equation and makes it a more attractive investment.